Hi, this is a presentation for the UCD Student Investment Society on valuation. This is part 2 of the presentation, which is about valuation using the method of comparables. Sometimes people call this valuation using multiples. There are two major ways to value a company using multiples. The first one is to compare the market value of the company to some balance sheet values, and the main one people use is equity. So shareholders' equity is equal to assets minus liabilities, and we can compare that to the value of the equity on the stock exchange, the market capitalization. So here what we look at is how the stock exchange has valued the company. For Ryanair, the stock exchange has valued the company at about 17.1 billion, and we compare that to shareholders' equity, which is how the accountants have valued the company on the balance sheet, and that gives us the market to book ratio, or it's sometimes called the price to book ratio. And for some companies, the price to book ratio can be 2 or 3 times. The market is valuing the company at 2 or 3 times what the accountants have valued the equity of the company at, by subtracting assets subtracting liabilities from assets. The other major multiple that you will come across, and this is the really big one, is the price to earnings ratio, or the PE ratio. And that ratio is defined as the share price over the earnings per share. And what does this compare? This compares what somebody is willing to pay for a share on the stock exchange to the earnings that that share is generating. There are all sorts of variations on this ratio, whether you use current earnings per share, forecast earnings per share averaged over the last 5 years. There are all sorts of different variations. But the basic idea is to compare your share price to some measure of earnings for the company. This is a comparison of multiples for Ryanair. Let's look at the PE ratio first. Ryanair's PE ratio is 13.69. EasyJet is probably the closest comparison here, and they're 8.89. So people are willing to pay more for €1 of earnings from Ryanair. They're willing to pay 13.5, more than 13.5 times. For EasyJet, they're only willing to pay about 9 times. And this usually refers to how people think earnings are going to grow in the future. If they think that earnings are going to go quite quickly, then they will pay more per unit of earnings than if they think earnings are going to grow more slowly in the future. So that's the PE ratio. The price to book ratio is 3.62 for Ryanair and 1.41 for EasyJet. What this tells you is that the stock exchange are willing to pay 3.6 times the book assets, or the equity, of Ryanair, and only 1.14 times the book assets of EasyJet. It can, in Ryanair and EasyJet's case, it's a little bit more difficult than that, because EasyJet use a lot more leasing than Ryanair do, so they have assets excluded from the balance sheet that Ryanair would have on the balance sheet, so it's a little bit more complex. In general, what does this mean? Well, it means the market expects the company to be able to make good returns on that equity in the future, and the higher the price to book ratio, the higher the returns on equity that they expect in the future. For some companies, people use a price to sales ratio. This is especially for loss-making companies where you can't really work out a PE ratio, or startup companies where sales and revenue are the most important things. And you can see Ryanair's multiple is much higher than EasyJet's for this metric as well. Price to cash flow, 10 times for Ryanair, so the market is willing to pay 10 times the current cash flow. And price to EBITDA doesn't make an awful lot of sense for airlines, because depreciation is a major cost for airlines. For other companies, you will see comparisons on price to EBITDA, and they generally line up with price to earnings. They're on a slightly different scale, but they usually give similar answers to price to earnings. So what does all this tell us? Well, it tells us that the multiples for Ryanair are already much higher than for other airlines in the industry. So this means investors have high expectations about cash flows and profits in the future, and they're willing to pay a high multiple of the current values of those earnings and cash flows to get a share of Ryanair. So our conclusion here would be that Ryanair is highly valued. Maybe that is justifiable by growth expectations, but it is highly valued right now compared to other companies in the airline industry. For references on this, chapters 17, 18 and 19 of Damaduran are very good. That is a standard textbook on valuation, and I think that is available as a free ebook in the library if you follow the link on this page. So the method of comparables or multiples, the first step is to identify comparable firms. So for Ryanair, we would identify EasyJet as a comparable firm that have operations similar to those of the firm whose values in question. Identify measures for the comparable firms in their financial statements. So do you want to use something like the price earnings ratio, the price to cash flow, the price to book, and then apply these multiples to the corresponding measures for the target firm to get that firm's value. So for Ryanair, there we saw EasyJet have a price earnings ratio of about 9 times. Ryanair's earnings per share at the moment is about €1. So if we were to apply EasyJet's multiple to Ryanair's earnings, you would only get a price of about €9 or €10, whereas right now Ryanair trades at about 14. So it doesn't seem to work very well. We saw earlier on in part 1 of the video that Goodbody's use a multiple of about a price earnings multiple of about 18 times to value Ryanair, and we'll see why they might have reasons for doing that in a minute. On Bloomberg, you can get information about these multiples in the EQRV screen. That's equity relative valuation. And you can see I've selected some multiples down here. These are FY1 PE is the current year price earnings ratio. FY2 PE is the price earnings ratio on the basis of forecasted earnings, and blended forward rate, that's kind of a blend of the two, the current and forward, and this is the price to book ratio from the latest filings. And those numbers are similar but not exactly the same as the ones I showed you in the last table. You have to be careful with Bloomberg because their definitions in different places are slightly different. Up here, this display shows you for those 4 measures a little graph of whether they are above or below their current, the current ratio for price earnings is above or below its historic average. So you can see Ryanair is slightly below its historic average. I guess for both Ryanair and EasyJet, Brexit reduced their valuations quite a bit, and their price earnings ratios in the past are higher than they are right now. So let's look at that in a bit more detail. This is the EQRV screen, and here I have selected the versus self tab. You can also, in your own time, have a look at group dynamics. That looks in more detail at all of the peer companies. But this screen here, versus self, is just for Ryanair. And you can see they give you a graph of the price earnings ratio over time. You can see that Ryanair's price earnings ratio fell quite sharply in June of last year, and this lines up with Brexit. It also had a fall in March of last year. I think that was in relation to a terrorist attack. Now, most of the movement there is in price rather than the earnings measure. But as we can see from this graph and the little lines, the little dotted lines here, Bloomberg have drawn in, Ryanair's price earnings ratio has been higher in the past than it is right now. The 16.6 line, it touched that back here, whereas its price earnings ratio is about 13.4 now. So if you were to think that Ryanair could return to these levels of price earnings ratio, then you can justify maybe a higher multiple for Ryanair than right now. I guess that there are two comparisons that you can do in relation to price earnings ratios. You can compare to peer companies like we did with EasyJet, and you can compare to the same company but over time. To get an idea of where price earnings ratios fall for different industries, this is a breakdown of the Bloomberg European 500 index. This is using the MEMB function. And you can see that sometimes you get very strange results for price earnings ratios. That could be because earnings are quite low for the energy sector right now, but prices haven't fallen that much. So you can get a very high price earnings ratio. You can see that the information technology price earnings ratios are much higher. These would be the averages for companies in the industry. Again, you have to be a little bit careful about averages here. It might be better to use the median or something like that. A few outliers who have crazy price earnings ratios can bring the average for an industry up. Companies in things like the utility sector have much lower price earnings ratios. Here the average is about 17 for those companies. You can also look at the price earnings ratio of a whole index over time, and this is for the Bloomberg 500 index, very similar to the Stocks 500. The green line is the price earnings ratio, the white line is price, and the tan line down here is earnings. So you can see the big picture here is that earnings have not changed that much over time. This is the aggregated earnings for all the companies in the index. The price of the index has gone up a lot since say 2012, and because of that the price earnings ratio has gone up. The green line here is much higher than it would have been in 2012. So I guess the price earnings ratio was about 14, 15 back then, and now it's up to 25 type of level. So you can do this graph using GF for individual companies as well. What do you conclude from this? Well, the price earnings ratio of this index has gone up because price has gone up, not because earnings have done anything. So investors are willing to pay more per unit of earnings for this index, and that assumes a lot of growth in the future. And obviously looking across this line here, there's no growth at all going on right now. So we must be expecting things to get much, our investors must be expecting things to get much better in the future. This is another graph of price earnings ratio, this time for the S&P 500 index. Similar type of thing than the last graph. And you can see the peaks in price earnings ratios were around 2000. The peaks in price of the S&P 500 were around 2000. That was the dot-com boom, or the dot-com bubble, when that burst. And prices have returned to those highs right now. This means that the price earnings ratios were extremely high during the dot-com bubble. As you can see, this is a graph going back to 1951, and price earnings ratios were very high at that point. Price earnings ratios at the moment, it's hard to say exactly. They're over 20 for the S&P 500. Whether that overvalues the stock exchange or not is debatable. As you can see, that is probably, if you draw a line back here, straight line back here, that's higher than in most of the history of the S&P 500, with the exception of maybe the 1990s. So whether that's overvalued or not is anybody's guess. Also, looking at the relationship between price earnings ratios and interest rates, the red line here are long-term interest rates, very high in the 1980s, and PE ratios very low, the blue line. As interest rates have come down, PE ratios have in general gone up. I guess that would be because the higher the interest rate, the more you have to discount future growth for companies. And right now interest rates are very low, so future growth in companies' earnings are discounted at a lower rate.